Suppose you wake up in early 2025 and open a market app feeling immediate disbelief. Every major index shows record highs, tech stocks surge aggressively, and AI mentions trigger euphoric trading. Nvidia emerges as the symbol of this era, transforming data centers into so-called AI factories. Hyperscale investment accelerates dramatically, reaching hundreds of billions of dollars annually across global markets. Microsoft, Amazon, Google, and peers deploy capital at speeds dwarfing previous technology investment cycles. On the surface, this environment resembles the early stages of a new industrial revolution. However, beneath the optimism, experienced investors recognize familiar structural patterns from past technology booms. Capital is not merely flowing into AI innovation, but repeatedly circulating within the same ecosystem. Identical dollars reappear across balance sheets as growth, revenue, and returns, masking fragile economics. This dynamic closely echoes mechanisms observed during the telecom expansion and the dot-com bubble. Consider a straightforward example involving a large chip manufacturer and an ambitious AI startup. The chipmaker provides multi-billion-dollar financing that appears visionary and strategically aligned. The startup then spends most of that capital purchasing the chipmaker's GPUs in bulk. These transactions often route through cloud providers or specialized leasing vehicles for efficiency. The chip company records soaring sales, while the startup reports impressive scale and rapid expansion. Investors on both sides interpret these numbers as confirmation that technological history is unfolding. Taking the path of a single dollar, however, reveals a more fragile reality. Investor capital flows into the startup, transfers to hardware suppliers, then reappears as revenue. This process inflates demand signals without necessarily creating proportional independent economic value. Unlike classic frauds such as Enron, the numbers are technically real but misleading. Researchers increasingly describe this structure as a circular AI economy driven by financial engineering. Vendor financing, equity stakes, and cloud commitments reinforce each other and amplify reported growth. Large cloud contracts frequently accompany equity investments, blending strategic partnership with revenue recognition. Special purpose vehicles borrow against GPUs, then lease them back to related AI companies. Central bank research highlights explosive growth in private credit funding AI-related infrastructure. Collateral for this lending often consists directly of data centers and high-end GPUs. Analysts warn that overstated long-term collateral values could generate severe losses during downturns. Not every AI deal is circular, and many firms deliver real products and cash flows. Some infrastructure investments will remain valuable even if overall AI demand moderates. Yet aggregated data reveals supplier financing and cross-ownership, exaggerating true market demand. The same dollar is effectively counted multiple times as it travels through interconnected entities. This mirrors the late 1990s telecom boom financed by aggressive vendor credit. Nortel and Lucent extended financing, carriers bought equipment, and growth persisted until collapse. Several analysts now draw explicit parallels between that era and today's AI infrastructure surge. Nvidia's commitments and hyperscaler capital expenditures frequently anchor these comparisons. One investor famously described the situation as a depreciation tsunami approaching overstretched balance sheets. The first critical lesson is that circularly financed revenue is inherently fragile. Revenue from independent customers paying with profits is far more resilient and informative. The second lesson is even more striking when examining AI platform profitability today. Many core AI companies lose money at unprecedented scales in technology history. Training and serving large models require immense compute, storage, and continuous energy consumption. These costs concentrate among GPU vendors and hyperscale clouds, charging substantial margins. Each user request incurs layered costs for hardware, cloud infrastructure, and internal operations. Some firms pursue vertical integration, designing proprietary chips to reduce external dependency. Google's TPU strategy exemplifies efforts to compress cost structures at massive scale. Independent semiconductor analysts estimate vertical integration can cut ownership costs by roughly 1/3. This cost differential is crucial because AI services generate relatively modest revenue per user. Low subscription fees and advertising models often fail to cover escalating compute expenses. Additional users can therefore deepen losses rather than improving profitability. Multiple studies suggest AI infrastructure spending exceeds monetization by 5 to 10 times. Sustainable revenue lags far behind the capital deployed into chips and data centers. This widening gap is increasingly bridged through debt and private credit mechanisms. Private credit funds managing nearly $2 trillion aggressively finance AI infrastructure projects. International financial reports show AI-related private credit expanding from zero to over 100 billion. Much of this lending is secured by GPUs and specialized data center assets. Funds assume strong resale values and utilization will persist throughout loan lifetimes. Analysts caution that GPU-backed debt could grow into hundreds of billions rapidly. A sharp decline in hardware values would stress both borrowers and lenders simultaneously. This structure resembles aircraft leasing and shipping finance cycles that unraveled quickly. AI hardware cycles move even faster due to rapid technological obsolescence. Depreciation accounting therefore becomes a critical yet underappreciated factor for investors. Cloud providers have gradually extended assumed server lifespans over the past decade. Amazon shifted depreciation from 3 to 4 years, then towards 6 years. These changes reduced annual expenses and boosted reported operating income significantly. Cash spending remained unchanged, but earnings appeared stronger through accounting adjustments. Analysts describe this as a quiet but powerful earnings tailwind. AI workloads disrupted this assumption by accelerating economic obsolescence of hardware. In early 2025, Amazon shortened useful lives for certain AI servers. Management disclosed this would reduce operating income by roughly $700 million. Accelerated depreciation had already negatively impacted earnings in late 2024. Analysts viewed this reversal as evidence that AI hardware ages faster economically. Other hyperscalers have not similarly revised depreciation schedules for comparable assets. Identical GPUs therefore receive different accounting treatments across major balance sheets. Commentators describe this discrepancy as a depreciation arbitrage, inflating aggregate profits. Some estimates suggest tens of billions annually in overstated hyperscaler earnings. Cumulative effects through the late 20s could exceed $100 billion. Shorter realistic depreciation would materially reduce reported profit growth rates. GPU rental markets reinforce these concerns through rapidly declining hourly pricing. New capacity and competition push prices toward or below cost of capital. Providers discount aggressively to maintain utilization and justify prior investments. Studies show GPUs bundled cheaply in exchange for long-term usage commitments. This behavior signals faster economic decay than accounting assumptions currently reflect. Alongside financial pressures, physical power constraints impose hard limits on AI expansion. Modern AI data centers often target power loads exceeding 100 megawatts. Proposed gigawatt-scale facilities would rival the consumption of entire cities. Building and equipping such centers can cost tens of billions each. Energy analysts estimate dozens of gigawatts of new capacity are required domestically. Power generation and grid upgrades require timelines far longer than data center builds. This mismatch creates bottlenecks that capital alone cannot easily resolve. Researchers warn that dense data center clusters may significantly raise local electricity prices. Community resistance and regulatory scrutiny could further constrain infrastructure deployment. These physical limits collide with financial optimism embedded in current forecasts. Goldman Sachs projects hyperscaler capital expenditures exceeding $500 billion annually. Approximately 3/4 of that spending targets AI-specific infrastructure. Total multi-year investment may reach trillions, requiring massive future cash flows. Macroeconomic studies warn that capex growth far outpaces realistic monetization trajectories. Failure to close this gap would stress debt finance projects significantly. Interconnected balance sheets could transmit distress rapidly across the ecosystem. A sudden crash is unlikely, but a prolonged margin squeeze appears plausible. Capex growth may slow, pricing weaken, and depreciation pressures intensify gradually. Hardware vendors would face flattening orders and rising competitive pressures. Cloud providers may cut prices to keep expensive GPUs fully utilized. Lenders would tighten terms and revalue GPU collateral conservatively. Companies reliant on circular financing structures would feel pressure first. When internal ecosystem spending declines, reported growth evaporates quickly. Revenue lines once viewed as unstoppable can stagnate or reverse abruptly. Individual investors must therefore focus on fundamentals rather than narratives. First, examine whether revenue originates from independent customers or insider ecosystems. Equity stakes combined with credit and sales warrant careful footnote analysis. Circular demand is real but far more vulnerable during downturns. Second, scrutinize capital expenditure and depreciation disclosures in filings. Extended useful lives amid falling hardware prices signal optical earnings. Shortened lives and write-downs often indicate conservative, realistic management. Third, monitor leverage levels and private credit exposure tied to AI assets. Rising debt against rapidly depreciating collateral creates classic financial mismatches. When cycles turn, debt remains while asset values and cash flows fall. Finally, observe insider behavior rather than relying on optimistic public statements. Quiet stake reductions often speak louder than enthusiastic long-term visions. History rarely repeats exactly, but structural similarities consistently reappear. Bandwidth once seemed limitless, just as AI compute now appears unbounded. Every cycle eventually meets constraints of pricing, risk tolerance, or infrastructure. Long-term winners build sustainable businesses serving real needs efficiently. As charts soar and headlines promise trillions, disciplined skepticism remains essential. Some growth is genuine, some circular, and some borrowed from the future. Your task is recognizing when rhythms shift beneath persuasive narratives. Focus capital on firms earning from customers, not financial engineering. Deeper analysis today enables resilience and opportunity during future corrections. Those who separate economic value from inflated numbers preserve and compound wealth.